Hello, and welcome to the AGH Wealth Management 2026 Midyear Outlook webinar. Appreciate you taking your time out of your busy day today and allowing us the opportunity to share our thoughts and those of our independent broker-dealer, LPL Financial, on the outlook this year. My name's Brad Bechtel. I'm president of AGH Wealth Management. Every 6 months, our firm provides our insights and outlook on the economy and the market ahead. The slides you're going to see today are available to you in a full color booklet, which we're gladly to provide upon request. During the presentation today, if you have any questions, please email us and we'll be happy to address those after the presentation. My partner in today's presentation is Brian Gensch. He's a certified financial planner and senior vice president here at AGH Wealth Management. His focus is on our firm's personal investment portfolios and strategies, as well as our comprehensive financial planning services. At the conclusion of today's presentation, email or call Brian or I, and we'll be happy to continue the discussions and answer any questions that you have. So without further ado, I'm going to turn the mic over to Brian.
Thanks, Brad, and thanks again for coming and joining us today, letting us share our perspective along with LPL Research, which is our broker-dealers research team's perspective. The slide deck we put out a few months ago by LPL, so some of these we've had to update a little bit on the numbers, but they're all still pretty relevant for the mid-year outlook. So while the slides may not be fully updated, our discussion will include all up-to-date economics because, as we know, a lot has happened even this week in the markets and with some earnings. So the first thing we want to talk through is a little bit about the policy side of where we're at in the markets, and then talk through a couple of their major themes that we see. And I'm hesitant to show a policy at the very beginning, just to make sure that we're rustling feathers and we talk about politics at the very beginning. So we hope to keep you through the rest of this presentation, but the goal for this is just to talk over the midterm elections. This is a midterm election year, and there are market implications that seem to follow with that. So we wanted to spend some time initially going over that, and then we would continue with the rest of the presentation. So all 435 seats in the House are up for re-election. The current House makeup is 217 Republicans, 212 Democrats, and 1 independent, and then there's a few vacancies, 5 vacancies. Democrats would need a net gain of 6 seats to reach the 218 majority threshold and win control of the chamber. And there are currently 35 competitive races happening right now. So the analytics are showing that there is a favorable probability that the Democrats could take control of the House, but in a relatively small margin. Now, this is actually pretty common in midterm elections. We see the House flips very often, and so that would follow suit with this year based off of just the pre-analytics of the polling. On the Senate side, there's only 35 seats in the Senate that are up for re-election, which include 2 special elections in Ohio and Florida for J.D. Vance's seat and Marco Rubio's. And the current Senate makeup is 53 Republicans and 45 Democrats, and 2 independents, and they caucus with the Democrats. So of the seats up for re-election, 22 are currently held by Republicans and 13 by the Democrats. And so Democrats need to flip at least 4 Republican seats to claim a majority. And there are currently roughly 9 or so competitive races. And so the analytics on the Senate look more on the weighing on the Republicans maintaining control of the Senate. And so what we thought we would do is just look at a few scenarios that could play out and what that might mean for the markets. So scenario 1 would be the most likely scenario, that the Republicans would lose control of the House but maintain control of the Senate. With the legislative pathways constrained, the White House would rely more heavily on than executive orders and agency rulemakings, and then regulatory reinterpretations to advance any policy agenda. And this would shift focus from the Congress onto really the administrative state. Winners and losers. So, agencies could continue advancing agendas with the administration through their rules. Particularly, we see in most likely crypto market structures, public company disclosures, e-delivery, private market access, and then capital formation. So stakeholders seeking statutory changes that require bicameral agreement would have an uphill battle, as divided control would make it harder to move large or partisan legislative packages. So what that really means is big things like the OBBA and other large packages that would need bipartisan support probably wouldn't then occur for the next 2 years. But bipartisan measures such as capital formation packages could still advance, but House and Senate leadership would need to make a concerted effort to resolve their policy differences. Affordability measures could still move on a bipartisan basis, but there's a likelihood that the minority, so the Democrats, may be reluctant to give the administration a major legislative win ahead of the 2028 presidential election without securing some significant policy concessions. And that's a pretty typical for the party that would be the minority party from the Oval Office in any given year. So scenario 2 then would be if Republicans would lose control of both the House and the Senate. And so if Republicans lost control of both chambers, legislative activity could remain constrained due to likely narrow majorities that the Democrats would then have, and the president's ability to veto legislation that does not align with the administration's agenda. And so with tight margins, it would be very difficult for Congress to override a presidential veto in both chambers without a strong bipartisan support. As in President Trump's first term, Democrat leadership in both chambers would place significant emphasis on oversight to shape political narratives heading into the next presidential election. Winners and losers, Democratic majorities would likely focus on advancing the Democratic priority legislation to show voters that they could accomplish with a unified congressional control, even though most of that would fall on its face when it got to the Oval Office because the president would veto it. Control of both chambers would give the Democrats subpoena power, committee gavels, greater ability to investigate the administration, shape the Republican narrative, slow implementation of Republican priorities. President Trump's judicial and executive branch nominees who would face a far more difficult confirmation process in a Democratic-controlled Senate. And what that really means then is a lot of policymaking would come to a halt, and it would be a very low policy-driven 2 years, which in some cases the markets have welcomed, where there's not huge legislative changes that they have to reprice the markets with. And then scenario 3, Republicans would then retain control of both the House and the Senate. And if they retained control of both, Congress would uphold the clearest path to advance the administration's agenda, their legislative agenda, particularly on affordability and other priorities that may not pass this Congress currently, including a capital formation package. Unified control would also give Republican leadership the ability to pursue additional reconciliation legislation, including further changes to the tax code. So if we did see a maintain of the current powers through the midterms, there's likelihood that we could see some tax code changes that could happen in the next 2 years. But the success of the legislative activity would depend on the size and the cohesion of the Republican Party, and it wouldn't eliminate the risk of intra-party disputes over spending and deficits and other disputes we've seen over the years. Winners and losers in the financial services and digital asset firms, they would most likely benefit from a greater likelihood of clarifying crypto market structure if it doesn't pass this Congress. Expanding private market access, modernizing public company disclosures, limiting perceived regulatory overreach. Agencies, including the SEC, would still play an important role in Congress would be more likely to codify agency action through legislation, virtually kind of future-proofing their regulatory changes for the next leadership. And then the Democratic leadership would remain limited in its ability to conduct investigations, set hearing agendas, or force votes on the Democratic priorities. So kind of almost more much of the same of what we've kind of seen over the last few years. One of the things that is pertinent to our industry and to our clients is that in a split government, some of the things that we've seen come out of that are the Secure Acts. And so Secure Act 1.0 and 2.0 both came out in 2020 and 2022. And those seem to be very bipartisan packages. And a lot of that affected the ages of certain things and the rules for 401ks, ages for required distributions, and other tax implications to companies and to individual tax returns. And so given the next couple of years and whatever the outlook might look like, it'd be very possible to see another Secure Act come to pass.
Brian, one thing I might add in here is one thing we have seen over the past, really since post-COVID, is a number of bills that became laws during that period of time. We are still waiting on regulations for. And so, in one sense, if you will, having limited new legislation might be a relief, just so that we could actually get regulations on the existing legislation that's already been passed. So I don't know, maybe that's a knife that cuts both ways for us, but getting some guidance would be nice, at least on some of the existing legislation that's passed and become law.
Absolutely, and that's kind of indicative of a normal cycle of new legislation like we've gotten. Is you get a lot of it all at once, and no one knows the clarity behind it, and it takes time to iron out the details where we can actually take those and then start strategizing with companies and with individuals about how does this affect you and what can we do to take advantage. So great point. So despite the differentiated results, markets have shown a historical precedent that post midterm election markets do tend to move positively. And so we look back at the last 11 midterm elections, and the S&P 500 had posted positive 12-month returns on all of the last 11 midterm elections. So effectively after the polling day and 12 months later, regardless of the outcome of that election. And we attribute that to the market's unwavering desire for clarity. And no matter the political party affiliation, just knowing that the government power is clear tends to be more important to the markets and a lot of times than what that power looks like. And we would expect a similar result of behavior, barring any major events or recessionary implications that we don't see today that would maybe cause that to change. Okay. So, resource nationalism is becoming an increasingly dominant force, with governments actively asserting control over natural resources to secure economic and geopolitical leverage. And the clear implication of this shift is structurally higher commodity prices as competition to secure the supply intensifies. Beyond commodities themselves, there are obviously commodity-linked equities, particularly in the energy and material sector, and then as well as commodity-exposed regions like Latin America. And those could be poised to be benefactors over time. And so that is a kind of a new theme that has emerged over the last few years. And then looking ahead to the second half of the year, we believe AI will remain a dominant driver of equity markets. At the same time, AI will also be an increasing source of uncertainty as the investment cycle matures. In the what we would say the next act, markets will face a transition moving from enthusiasm about the AI infrastructure build out and surging earnings to more of a balanced debate around the returns on the massive capital spending and who will be the biggest benefactors. And we just this week saw the effect of Microsoft showing a return on that capital through their Azure and Copilot revenue increases, and then just after the bell, Amazon, same thing with their AWS service, and then we can see what happens like with Apple today when it disappoints investors. So for the last 3 years, there's really just been a lot of enthusiasm about the future of AI. We've kind of matured that investor profile into more of a needing to set expectations for these companies to show us a return on that investment capital. And that's going to be what I think is a next wave of the direction of the markets, is how that plays out over the course of the next few quarters. Should AI's next act deliver, we believe the US and emerging market equities would continue to benefit given their leadership positions in those spaces with their supply chains. But the hyperscalers face risks that the investment cycle peaks, while AI tools may further disrupt certain software businesses. So we've seen kind of a dichotomy of effect of the AI innovation and path over the last few years. In one sense, these hyperscalers and semis stocks have seen a growing interest in their positions, and at the same time, we've seen a huge disruption in the software business for companies whose we call them software as a service companies, like Salesforce and Adobe and Palantir and all these ones that now are facing a disruptive threat from AI. We do believe a lot of that will sort out over time, but the main concern right now is the capital investment by the hyperscalers. It's just been extremely extraordinary. The 5 companies you see here, Google, Amazon, Meta, Microsoft, and Oracle, could invest more than $750 billion in AI infrastructure this year, which is much higher than even last year's massive increase in capital expenditure. And then that number could exceed even $1 trillion next year. So investors are going to stop being excited about the future in AI and become more concerned about when that return on the investment actually starts appearing.
Brian, I sort of feel like we could have shown a Jerry Maguire show me the money slide here instead. That would have made about as much sense. So yeah, I agree.
Yeah, it's interesting because you really are seeing it company to company. So, and we're kind of getting into these companies. Google reported and it was disappointing. Apple and Meta were disappointing. So you've seen those today, and then Microsoft and Amazon were positive. So it looks like the investors are really starting to reward those who are showing the proof in the pudding, and then really starting to hammer down and get away from the ones that look like they're not actually sustaining a positive revenue growth and earnings growth over time. So that is going to theme out for more than a few quarters, but it'll be important to see when that return on their investment capital comes. So looking more on the yield side, the risk is that prolonged geopolitical stress has kept energy prices elevated longer than expected, and it could amplify a second order effect across sectors, complicating the Fed's policy decisions. And so as a result, the current environment is expressing that the Fed is likely to have a rate hike in the near term, removing any bias toward easing and any rate cuts, and further tightening then if conditions are warranted, even as the market grapples with a heightened uncertainty about the timing and credibility of any real return to a target inflation. The new Fed chair is creating a bit of uncertainty about the next rate decision, and the short end of the yield curve is rising. And then most recently, the long end of the yield curve, even this week, accelerated up with the Fed speak following their meeting. And so we expect the Fed to remain on hold this week, which they've obviously did. And then we look at for the next few meetings to see what that probability of rate increase could be. I think there were 3 dissents this week, which is a significant amount of dissents. And the dissents just mean that there were 3 people who didn't want to hold the rates, they wanted to raise them. So the more dissents we see in future meetings with the rate hike maybe not happening means we're getting closer and closer to that rate hike. If you look at the futures market, it's pricing in, I think it's like a 60%, don't quote me on the number, but it's like a 60% chance that there could be 2 or even 3 rate hikes by the end of the year. So there's a bit of stress happening in the markets, especially on the bond side of the market with that. What's been positive about that, though, is that is Treasury yields have risen back up. So a 2-year Treasury and under have started to increase return on their investment for safe investors who are investing in short-term securities. So from an economic standpoint, growth should moderate but remain positive in the second half of the year, assuming strong business investment, which would help offset the weakening in the housing market and then other rate-sensitive sectors. Obviously, again, spending on AI-related equipment, intellectual property, non-residential structures, that all will continue to prove an important cushion for overall activity in the business space. Elevated household net worth relative to income will continue to provide an important buffer for consumers and help support demand. Now, we have heard, and there's a lot of talk out there, this is a K-shaped recovery. So the haves have more, the have-nots have not recovered the same, if at all. But from a holistic looking at the how households produce income and weighted towards that income that is able to be spendable, there's still a strong household net worth currently when you consider the income coming in. So that gives us a holistically a healthy consumer, which we need because our economy grows. 60 to 70% of that growth comes from us spending money at the household level. Inflation will should hopefully ease by year end. Again, that's going to be predicated on the geopolitical tension that's happening in the Middle East, and if that gets resolved. If that does, we would expect inflation to moderate down below 3% by the end of the year. Now, that is not where the Fed wants it. The Fed wants it at 2%. And so I think they even reinforced that this week. And so I think that's been some of the scare that we saw in the markets the last few days, minus yesterday, was because if they're really wanting it to be at 2%, then that almost certainly puts in a rate hike for the year, because we'd be happy to be at 2.5 to 3% by the end of the year. And then unemployment should edge higher, but remain really historically low, rising to around maybe 4.5 or 4.6% by year end, as hiring stays subdued. But right now we're slightly underneath that. So the wealth effect is still a major factor driving economic activity. And so we should expect healthy nominal growth in the next couple of quarters. Nominal growth is the key factor behind earnings growth. In addition to well-heeled millennials, the baby boomers are spending more than their parents did at the corresponding ages. So we have a healthy spending household in America. We're really good at spending money, is what that means. And that is what drives a lot of our economic activity. If the 1990s are any guide, we should expect the capital expenditure boom to continue. Business spending on software, IT-related equipment, and research and development projects will support economic activity as well in the next several quarters. So we do expect inflation pressures to abate, like we said, later this year and into next year. But in the meantime, consumer inflation will be a concern for markets and the Fed. And for examples, strong demand for healthcare services and then the geopolitical tensions have been negative impacts with inflation dynamic, and that will continue for the near term. But our long-term view is that markets will perceive the Fed to be a credible, politically independent entity, which will help inflation expectations to remain well anchored. And in jobs, the services side of the economy should continue to add to corporate payrolls for the next few quarters. We're still in a low hire and low fire labor market. Firms are still adding to their payroll, but hours worked are below pre-pandemic levels as firms cut back labor utilization. So a concerning trend is that increasing flow of individuals dropping out of job market altogether. And for now, the labor market is holding, giving the Fed opportunity to stay focused on price stability, but it's something to be watching. The unemployment rate ticked down to 4.2% in June last month, as fewer people were looking for job in the month of June. And in a strong economy, a low unemployment rate can coexist with healthy participation rates, but that's not the case today. Hours worked actually has declined in recent months, indicating an upcoming slowdown in the broader economic activity maybe next year. Labor force flows are revealing and providing another perspective on the labor market. We've seen a rising trend in people dropping out of the labor force, whether they were previously employed or unemployed. And this suggests the job market is cooling. Now, there's also a few reasons we can justify some of that. And that it is with the AI implementation that a lot of companies are bringing in, that you can become more efficient as a worker. And so maybe your hours worked declined, but your productivity didn't necessarily decline. Those will be important factors to measure as we move through the next 2 to 3 years, with how this actually affects our job production or our capacity per worker. Well, and one thing I talk with clients and with others a lot about is, one of the issues I see long term, so not a short term as what this looks like, but more in the long term is our population growth of workers in the U.S. And if you look back in the early 2000s, we were growing at about 1.5% or so rate. But today, if you look at the last 5 years, our population growth is consistent of two things. It's consistent of organic growth, so us replacing ourselves as workers, and then it's immigration. So we bringing more workers to the country, and those two things have both declined heavily in growth. And it's for the first time, and I've been watching this metric for a long time. So I don't know if it's been 15 years, but 10 to 15 years. And I've never seen the 5-year projected numbers go negative. And right now, because of the expectation that we'll have a negative growth, so a decline in immigration population over the next 5 years, we actually show a slight decline overall in the working age. So ages, I think it's 16 to 64. And so that alone, that has implications to our ability to have the jobs we need to produce the output that we want to produce as a country. And so that is one of many different things, but it is something that is more of a long-term discussion, not so much something that's going to affect us in the next 1 or 2 quarters.
Brian, I'd add to that, I agree with you. I think that's a significant long-term concern that I have as well. When you look at the decision that childbearing folks are having with the cost of housing and the cost of goods and services, there's decisions, and throw childcare into that as well. The high levels of cost in those areas, and then coupled with housing, is causing folks to begin to have to make decisions on, will we have a house or will we have kids? And as you extrapolate that forward, you start thinking about, even where we're at with the Social Security Administration and the amount of money that's in the fund and its expected trajectory as far as being able to continue to pay. So there fewer workers, lower amount of money going in. There's some pretty long-term significances to this aspect. So yeah.
Well said. All right, so let's talk a little bit about stocks, and then we'll talk about bonds and a few other things and wrap it up. So we expect the bull market to continue in the second half of the year, bolstered by an improving macro backdrop, strong earnings growth, and then, of course, AI execution, developments in the Middle East, and then AI monetization progress will actually determine more the magnitude and frequency of the pullbacks. So we feel like those are the two pieces that are causing the most swing effects in the markets intra-year. So the conflict in the Middle East and then the AI's ability to produce results, which this week's been a good testament to that, are what will cause the markets to have the biggest moves. LPL Research expects modest gains for stocks in the second half and recommends a more modest overweight allocation to the U.S. equities to take advantage of that. But like we said, one other area of the overall market that will benefit from the AI build out is going to be emerging markets. Diversification will be critical as well, as portfolios may benefit from the exposures balanced across all the AI themes and the potential beneficiaries of the market rotation that we can see over the year. But we don't see recessionary environments going up. In fact, those are actually, they tend to be lower than normal right now as far as the probability of recession, which allows us to kind of hold higher valuations in the markets. I don't know what it looks like. We're not going to, LPL, and I'll give it here in a little bit. LPL has a end of year price target, but we'll never at AGH we'll never talk through what we think the actual returns could look like at the end of the year. And it's just such a range, and depends on when those pullbacks hit and versus when the calendar year ends. So, but we do expect to see a bullish tint to the market, which just means it's more of a you take more of the buy the dips and not sell the rallies. And so that's kind of how we talk on our investment committee. If we see volatility, is this a buy the dip opportunity, or if we see volatility, is this a sell the rally volatility? So we would lean more on the former. Stock market gains so far this year have been driven by earnings, not by higher valuations. First quarter earnings growth near 30% was extraordinary, and then encores is coming in the second quarter. We're only a month in, but our current reports have shown about a 36% earnings number, which has been really strong. AI fuel technology earnings have far exceeded the expectations as a whole, and as illustrated in the rare and steady increase in earnings estimate chart that we see in front of you. That's a very mouthful of a name. The S&P 500 earnings per share estimates for 2026 and 2027 have risen by about 10% year to date, compared to an average 3% reduction that we tend to see. And that's just a function of companies tend to come in and reduce their earnings expectations when they do these reports, especially through the first quarter. And that is always just them setting themselves up for not disappointing. So under promise, over deliver. But when you see a 10% increase in earnings estimate that they're reporting, that shows a high confidence level at the business level that they can hit those targets. The S&P 500 earnings per share then are on track to grow over about 20% this year. But the growth is concentrated, obviously, in a few sectors, which is expected to drive most of the overall increase. So that's obviously something that is a positive bull shaping move in the markets right now. U.S. stocks are trading at slightly elevated valuations. We have been for you could argue for quite a while, for a few years, based on just a simple price to earnings ratio calculation, where you're basing your price off the earnings and how much are you going to pay for those earnings. And that's led to some to characterize the stock market as overvalued. However, based on our macroeconomic outlook and the fundamentals of these companies, we would consider the stock valuation fair rather than extreme. Stock valuations are a function of several factors that we believe are supportive of a slightly higher PE ratio in the next 6 months. So some of those things are the above average earnings growth that we've seen somewhat justify then the valuation. Like I said before, the below average recession risks, which bolstered by the stimulus and the AI spend, and then margin expansion opportunities from AI. And we've seen margin opportunities like crazy in the S&P 500. I think the last I checked, profit margins as a whole in the S&P 500 were at about 16%, and that is the strongest we've seen in a long time of what kind of margins we have. So earnings are going up, margins are going up, and revenue is going up, and that's all justifies maybe seeing a higher valuation. And then the potential for an improving macro backdrop, so a macroeconomic backdrop that could improve over the next 5-6 months, adds to that confidence level. So we're more confident in the first three pieces, and not that last one, but because that's just a tougher call. But if that backdrop improves, especially with the Iran conflict, if it can wind down, we do expect to see some more expansion of PE as inflation could ease. So a scenario to play out would be inflation steadies, conflict reduces in Iran, and what we would see is investors would be more willing to pay for these earnings than they are today. If you actually look at like the total return of the S&P 500 year to date is based off of three primary functions. One is their earnings growth. The second one is, have they paid any dividends? And you basically add those up, and then the actual return we're getting is based off of our investors' appetite to buy the market, and that's what that PE ratio is what's the multiple we're willing to pay for those earnings, and then add the dividends in. If you look at this at the beginning of the year versus today, we're actually trading at a lower multiple than we were at the beginning of the year, which is why you're not seeing the market up 20% with showing earnings reports that are in the 30 and 35% earnings growth year to date. So, if we do see some more certainty come back in the market, and earnings don't get sideswiped by some major event, this is what creates our base case that we could see the market move higher for the rest of the year. Just to keep talking about the tech sector, because it is just kind of the area of focus, the sharp rally in the semiconductor stocks in AI has sparked a comparison. We hear a lot about, oh, well, this is just like the late 90s and the dot-com bubble. And if you look at from March 30th of last year through the beginning of June, the Philadelphia SOX index surged 225%, compared with the S&P 500 went up about 35%. And so thus you get some of these, these relaying back to early 2000 or late 99. Earnings may have justified the rally broadly, but the extreme move in some of the leading chip names was extreme and accompanied by stretched positioning. And so, simply put, market participants own a lot of AI names. And that observation was the primary reason that our research team downgraded the technology sector in early June from overweight to just a neutral setting, despite having a 50% earnings growth this year. The biggest winners of the AI trade may simply need just a cool down period. And again, I feel like that's where we've been in. That's what we've experienced in July, is we've seen a decent cool down period in those large names. And really just recently, with earnings coming out, it's bringing investor confidence a little bit back into the picture for the ones that are showing the results.
Brian, I might just kind of remind everyone. I mean, this is not something we're just now seeing. I mean, this is something that we anticipated 6 to 9 months ago, and if you kind of go back and look at and listen to some of our prior outlooks, this cooling, of the MAG group of these, large tech companies, we actually thought that this would, and we anticipated that this would begin to happen, and we have begun to see that move that direction. So it's not everything that we always think is going to happen happens, obviously, but it is kind of nice to have seen this one play out.
Yeah, absolutely. All right, so if you want to have your pen and paper put together and you can hold LPL to this, LPL's current base case assumes that there's more macro drivers that they break positive than negative, and it allows AI-driven earnings boom to carry stocks higher in the second half. However, with uncertainty around the geopolitics and the benefits of AI and all that, a lot of optimism has already been priced in. Volatility could remain elevated. And again, midterm election year typically see elevated volatility up until November. Our research team's updated year-end fair value forecast for the S&P is right around 7,700 points, based on a $350 earnings per share for 2027 and a 22 times price to earnings ratio. So that's where they get that. If you go look at the broad scheme of everyone putting out these numbers, they're kind of right in the middle. There's companies out there that are being more conservative than that, and then there's companies out there that are showing a lot more aggressive pricing into earnings or pricing into our multiple at the end of the year. So it's just a range of where we could be, but they do put this out every year, so we're happy to share this each time. Okay, for the bond side, still a resilient economy coupled with the sticky inflation. It just means that the Fed is on a prolonged pause and most likely into a rate hike. And so again, Treasury yields are likely in a trading range. They're elevated, but they're now what seemingly looks like in a trading range until inflation falls meaningfully this year or the economy weakens. As neither represents the base case that we see, we think that the 10-year Treasury yield should continue to stay range bound and trade in that 4 to 4.5% range. The additional compensation. So when you're looking at bonds and you look at treasuries, then you say, well, okay, let's go to a more risk asset. So you move to corporate bonds and see the additional compensation or the spread to own the corporate bonds remains pretty muted. There's not a lot of added return that comes with buying an issuer that can't print money. So though we could see upward pressure on spreads for the hyperscaler companies that are leaning into the debt markets to fund their AI buildouts, short to intermediate corporate bond exposure is attractive for income-oriented investors. And with the rates probably staying where they're at or going up, we would continue to see whatever income you're producing off of portfolios on the fixed income side probably maintains its characteristics for the rest of the year. Returns will likely be income driven as Treasury yields stay in this range bound nature and credit spreads remain tight. When you look at the bond side, you can invest in the kind of the core side of the bonds or what we call core plus models, which add in agency mortgage-backed securities and agency-backed securities and mortgage-backed securities and other types like that, and then some unconstrained strategies where there's not really, and we're talking funds that would invest in the bond market and unconstrained strategies that just really don't have a prospectus limitation and they can go wherever they want. Those could perform well in an environment like this. And then also you could see, we've had a lot of Treasury buyers over the last 4 years. We could see more of a demand for the Treasury inflation protected securities, which would be the TIPS. And so those could prove as also positive positions for a bond portfolio. Markets that began the year debating how many rate cuts were coming were suddenly pricing meaningful odds of a rate hike with the assumed neutral policy rate, the level that neither stimulates nor restricts the economy, revised up towards 4%. So basically saying, where do we think the Fed wants to land the plane with rates, where they think we're not stimulating the economy by it being too low or restricting the economy by it being too high. And the market's pricing that in right towards 4%. Even after the presumed U.S.-Iran conflict and the deals that keep kind of falling through, markets still have assumed a rate hike is more likely than the rate cut. And we've seen that price in the bond market. Even under new leadership in the Fed, we expect the Fed to deliver at least one rate hike this year. And so that plays into the bond market returns. As you know, bond prices move with interest rates in a negative correlated fashion. So if interest rates go up, you see a bond pricing in your portfolios that will drop and vice versa. And so with this kind of reinvigorated yield curve that's gone up, we've seen the bond market as a whole perform pretty poorly this year. And so I think last I checked, the overall bond market measured by the U.S. aggregate bond market was trading at either flat or slightly negative for the year. And this is kind of indicative of what we've seen over the course of the last 5 years. In most of the years, bonds just have had a struggle performing. Now, the difference between today versus maybe 5 years ago is the coupon rates we're getting, because interest rates are higher than zero where they were 5 years ago. Those coupon rates have given us at least another reason to own the bonds, because we can at least create some income out of it. But bonds are having a challenging year. And so the question could be, well, then why do you have them? Bonds still do really well in recessionary environments. We saw that play out last year in April, when the recessionary probabilities went from their normal every year probabilities to Liberation Day announcement, and all of a sudden JP Morgan's putting out a 60% chance this year, in last year, that by the end of the year they would have a recession. And all of a sudden you saw bond prices whip up because all the rates started coming down. And so bonds are kind of that necessary evil in your portfolio that don't give you the growth you might want as an investor, but give you that stability when we see economic data decay, and especially if we start seeing increased exposure to recessionary risks in our economy. So that's the reason why you hold them, and hopefully now we can get a little income while we wait. I think an interesting development in the bond market, and that's a hard word to say, or sentence to say, because bonds tend to be really, really boring. But one of the most interesting things happening in the bond market is the AI story. Long being an equity market story or a stock market story, they have now migrated to bonds. The hyperscalers like Amazon, Alphabet, Meta, Microsoft, Oracle, and others used to fund all of their ambitious spending entirely from their internal cash flow. So all their free cash flow was going towards buying into this AI movement and capital expenditures. Not anymore. Building data centers, securing chips and powering them requires lots and lots of money beyond even the amounts they have available in cash flow. So a lot of these companies have started issuing bonds last year. And so roughly $110 billion of bonds in 2025 were issued from these companies, more than 5 times their 2023 and 2024 issuance trends. And estimates point to this year exceeding $300 billion of AI-related investment grade supply in the bond market. And, again, potentially getting super high in the trillions in the future. The borrowers themselves remain in excellent financial shape. And so hyperscaler leverage runs at a fraction of the typical investment grade company, and new deals are routinely oversubscribed. So we're seeing a lot of people flock to these bonds to get them. But still, the sheer scale is changing the market's characteristics in the bond market. Because data centers last decades, the bonds themselves are long dated bonds. So the bonds that they're issuing are not, maturing in 3 or 4 years. These are longer dated bonds. And what that does to the overall bond market is that adds a sensitivity to those rates that change. When you own a longer term bond, say a 30-year bond, if you see a 1% movement in the rates, you will see a large drop in those bond portfolios. If you own a 1-year bond and you see a 1% move, you will barely feel that in the price of that bond as it moves, because it's so close to maturing. So when we've infiltrated the bond market with a bunch of longer term bonds, specifically in this hyperscaler industry, that has created a longer duration of the overall bond index, which does make it a little more susceptible to interest rate sensitivity. So that's important to know being a bond investor, that you could, and if you're investing in indexes or you're investing in funds, there's a chance that those funds start becoming a little longer in their maturities on average, and that could become a little more sensitive to those interest rates. And that's about as interesting as we can get on the bond market. So, otherwise, bonds are boring, and we want to keep it that way. So talking a little bit about just other areas of the market. So, the first half of the year has been marked by rate uncertainty, geopolitical risk, policy ambiguity. And this environment highlights the limitations of, what people who would just own a stock bond portfolio. So say a 60 stock, 40% bond portfolio. And it does strengthen the case for bringing in other pieces that don't move the same. There are liquid alternatives. So you've seen long short equities, market neutral strategies, and those are positioned well as AI adoption creates clear winners and losers across the industry. So what that means is you have the ability to be bought into maybe the semiconductors and hyperscalers, but you could be shorting the software as a service companies or the ones that are getting hurt because of this. So it's created a little bit of more clearly defined opportunities in some of these spaces than we've had before. Increasing stock dispersion and volatility are creating these opportunities for the stock picking people and managers in these funds. Global macro managers are benefiting from a diverging central bank policies. So not every central bank around the country, around the world, are doing the same things, and that bifurcation of each of the individual central banks' policies being different creates an opportunity for global macro managers. And then managed futures, which is like you would consider like trend following in the stock market, bond market, currency market, commodity market. They remain somewhat valuable as diversifiers. When you see heightened stress in the markets, those can sometimes capture really good returns or lose out on, or well, not lose the kind of losses you might see in a bond or stock market with bad returns in those traditional spaces. Private markets also have shifted from what we would consider a risk-driven environment. So you go in there to add more risk to your portfolio, but those have shifted a bit to requiring greater manager skill and operational execution. So we're getting a lot better private asset opportunities. One of the areas that is the most interesting right now is, again, coming from the AI build out, is the infrastructure remains attractive due to inflation-linked cash flows and growth opportunities tied to digital infrastructure and data centers. I was watching a deal a few months ago from one of the private equity groups just talking about this data center demand. And right now we are building more data centers in the US than basically if you take China out, the rest of the world has already in data centers. So if you add up all the data centers outside of China, across every other country but the US, we are currently building in the US more data centers than that. And so there's a demand here, but there's also a demand there for them to build more data centers. And so that infrastructure build out is something that we're very interested in. And we relate it to the Wayne Gretzky quote, go where the puck is going, and or not invest in the company, but invest in the picks and the pickaxes and the shovels that create these new centers and these new infrastructures. So those are interesting things that not only we have public exposure in the liquid markets, but there are private. There are also ones private availability there, and those just have specific requirements for investors to be a certain type of investor to be able to be in, but a lot of investors can qualify for that. So those are things that we're looking at as well, just ways to help diversify across the normal stock bond portfolios that we have. And in a similar vein, commodities, and currencies, they both have a differentiation effect to traditional stock and bond markets. If you look at the historic first half commodity shock that we've had this year with the Iran war, the Strait of Hormuz closure, it removed at least 10% of global oil supply. Now that oil supply wasn't dependent for America, but it was 10% of all global oil supply. Crude prices surged above 120. We all saw that within days. Energy shock pressured risk assets, growth expectations, inflation forecasts, and all the things that came with it. And that benefited some spaces in the commodity side. Shock reinforced it reinforced that commodity bull market. The Bloomberg Commodity Index briefly reached its highest level since 2013 at the beginning of this year, before coming off the top. Even after tensions eased, commodities entered the second half outperforming broader equities. So there is a reason also to see a diversification into the commodity sector as well. We also believe in the commodity sector there's an exposure to energy that you can have, whether it's nuclear or fossil fuel energy or like oil energy or lithium or uranium. But a lot of this energy is needed because of the build out that's happening in the infrastructure that's happening in data centers and in AI. The amount of power we need to run these data centers and to create the energy for these bots that are happening all over the world is massive. And so there's a whole re-innovation that needs to happen in the energy sector. And so there's opportunities there that we'd say haven't always been there in this space, and it's something that we just continue to keep our eyes on. And then finally, just the dollar, the U.S. dollar. The U.S. dollar index entered the second half of the year nearly unchanged from where it started, but the underlying macroeconomic forces remain pretty highly dynamic. So again, the geopolitical tensions with Iran strengthened the dollar as investors sought safety, driving increased risk aversion, higher oil prices, rising inflation, all the things that we talked about. As tension eased, some of those supportive factors faded, but higher yields and improving rate differentials, along with a renewed confidence in the U.S. exceptionalism, have remained a steady tailwind for the greenback. From a technical perspective, the dollar remains at an important inflection point. So sustaining above this 100, so for the dollar index, anything above 100 would confirm more of a bullish outbreak from the current range that it's in. And then if it starts getting under 95, you start looking at a bearish outbreak on the downside. So, why does that matter? Well, the dollar movement, matters against precious metals. It matters against commodities. It matters against international stocks or U.S. stocks that are doing a lot of business internationally and bringing a lot of revenue in internationally. If you have to hedge a strengthening dollar, it's a lot higher cost to your business than if the dollar's weakening. That's why we saw last year with the dollar weakening in that year, 8 to 9%. We saw a really strong outperformance in international markets versus the U.S. So the dollar has it has an effect on the bond and the stock market. And so right now being range bound, that kind of takes it out of the picture. But if we were to see that move in any meaningful direction one way or the other, that would have implications in the markets. So that makes up the majority of our information today. Again, we know there's a lot there, and we welcome feedback, we welcome questions, but we wanted to just say thank you for your time today, and hope that it's been valuable. And as a reminder, our research team at LPL puts out a monthly client-approved report of their pulse on the markets in different sectors of the markets. And so if you're interested in any of these at any given month throughout the year, please reach out to us. Let us know. We'd be happy to share with you their most recent publications and how they feel about international versus U.S. or large versus small companies or other sectors and areas of the market. Please don't hesitate to contact us as well if you have any questions from the information that you heard today, or if you have any information that you want us to talk to you about your own investment portfolios, whether we are currently helping you with those or not. And remember that when you invest, maintain that long-term time horizon. A lot of times these webinars we can get into the short term, what's happening in the next 6 months. Making investment decisions has as much to do with to know what the long-term objective is of those monies that you're investing should be versus just the short-term tailwinds and headwinds and what might change over the next few days. The market has a very good way of shocking us and making and moving the way we shouldn't have thought they should move in the short term. So continue to maintain a long-term time horizon as you invest in stocks and try to keep that as your main reason for your investment decisions. And so as we swing through these many disclosures, just want to make sure that you're aware that Brad and I are available for questions after this webinar today. If you'd like, please please come either call us or email us with questions. We'd be happy to give you any information you need. And with that, I'll turn it back to you, Brad, for any additional comments.
Thanks, Brian. I appreciate it. Again, I want to thank everyone for joining us today as we shared our insights and outlook on the economy and the market ahead. Brian, I really do appreciate the emphasis there at the end on, focusing on the long term. I do think that, the markets, as we continue through the year, are going to continue to be volatile. They're going to continue to have days of big movement, and it's very easy to become, worried, fearful, concerned. And the long-term outlook, the long-term view continues to be critical to your long-term success. And so I think as anyone working with us, we always say, if you have concerns, please call us, and we will be happy to talk to you and allay the fears if we can, and get you in a position that you're the most comfortable. As I mentioned at the beginning of the presentation, a copy of these slides is available to you in a kind of a full color booklet, which we're happy to make available to you. Just let either Brian or I know by email. We're happy to send that out. And as Brian mentioned, just please call us or email us if you've got any questions about the presentation. Happy to discuss it with you. So again, thank you very much for your time today. We certainly do appreciate the time that you give us for this. Thank you very much.